Every now and then, you'll see an asset class that no one really cares about until suddenly everyone does. Right now, there's an asset class that's been ignored for a while, but the data is telling a very different story about what could happen next year. Yep, we're talking about REITs today. I'll be giving you 3 reasons why REITs could rally next year, and you can decide whether it'll be in your portfolio. Now let's get into it. Number 1. REITs have outperformed stocks in rate-cutting environments. As you all know from our previous videos, REIT stands for Real Estate Investment Trust, and it's an asset class very sensitive to interest rates. Now, the Fed's already cut rates by 50 basis points this year, and markets are expecting another 25 basis point cut this month. So what does this mean for REITs? Well, historically, over the past 50 years, in the year after a rate cut, REITs have actually outperformed the broader market. And here's something interesting. When the economy was already in a recession at the first rate cut, REITs performed extremely well, returning nearly 29% in the 12 months that followed. Now, the US wasn't in a recession at the time of the first rate cut this cycle, but even in those non-recession environments, REITs have still gained an average of 10.75% over the next 12 months. Now, we're not predicting numbers like that, but the setup we're seeing today, we'd say is getting quite similar to the periods before REITs started outperforming. Now let's talk about reason number 2. REITs have outperformed stocks over the long term. If we zoom out from the rate cuts and look at the bigger picture, REITs have actually been really strong long-term performers. Over multiple decades, 20, 30, and even 40 years, REITs have actually often beaten the S&P 500. Not every single year, of course, but across full cycles, the long-term returns stack up really well. Now, a big part of that is income. REITs are legally required to pay out 90% of their taxable income as dividends. That's why about half of their total returns come from dividends alone. For the S&P 500, dividends have made up only around a quarter of returns. And here's why that matters. Dividends help smooth out the ride. In a market dominated by fast-moving tech stocks and big swings, REITs offer something simpler and steadier. Predictable cash flows backed by real assets. So if you're thinking long-term or looking for more income-driven growth, this is a big reason REITs tend to outperform over time. Now let's head on to reason number 3. REITs offer strong diversification and help manage volatility. Now, the third reason is all about what REITs do for a portfolio, especially if stability is something you value. Dividend payers, and that includes most REITs, have historically been less volatile than stocks that don't pay dividends. Looking back from 1973 to 2024, dividend-paying stocks had a noticeably lower beta, meaning their price movements were calmer than the broader market. And that's important. Most portfolios today are heavily tilted towards tech and growth stocks, and those sectors can move a lot, both up and down. REITs don't behave the same way. Their earnings are tied to leases, physical properties, and long-term contracts, which tend to hold up better when the economy gets shaky. That makes REITs a useful stabilizer, something that helps reduce the overall ups and downs. So if you want a portfolio that feels a little steadier and not so dependent on the big swings of the stock market, REITs can play a really helpful role. Given the volatility of the recent markets, it won't be too surprising to see investors moving into less volatile assets in the next few months. So there you have it, guys. 3 reasons why we think REITs could rally next year. If you'd like to dive deeper into REITs, we've added a link to the full article in the description down below. There you'll find a breakdown of the key risks to keep in mind when investing in REITs. Plus, it looked through some of the largest REITs in the US, the UK, Australia, Canada, and India. And if you want to go even further, such as comparing yields, checking financial health, or exploring the different REIT sectors, you can do all that using the Simply Wall Street Stock Screener. Thanks for watching. Stay informed, stay diversified, and see you in our next video.